Next item is the private equity semi-annual report. Hannah Schreiner, Steve Hart, and John Haggerty. Welcome.
Good afternoon.
Afternoon.
So I'm joined for this report with my colleague Hannah Schreiner, and we're going to go through the slide presentations here. Just as a reminder, this is going to be information as of March 31st, given the delay in reporting that one gets from the private equity portfolio. And to Paul's note, as we've been talking about performance, this is all net numbers, and it does not include any information about fees, but we'll work with staff hearing about the discussion here to see about what we could do to incorporate some gross numbers in some of our reporting going forward. So what I'm going to do right now is talk quickly about some overview topics here. Hannah will provide some information about the program, and we'll finish up with some discussion about the performance to the March 31st date. So in terms of the portfolio here, in terms of some key metrics, the portfolio, as we mentioned here, is diversified by manager and strategy. The buyout segment is the largest segment. It is now at 69%. That compares to last year, where it was about 63%. So there's an increased exposure to the buyouts. That's probably as a result of increased commitments to that space, but also the values have been increasing. We'll talk about the performance of the portfolio has been quite strong. One lumpiness in the portfolio that we've been discussing is the exposure to the 2005, 2008 vintages was a lot of commitments during that time period. Now that represents the 37% of the portfolio. Previously, that was 41% a year ago, so it continued to diminish. There's remaining very little remaining uncalled commitments there. My guess is that given the age, almost all that is going to not be called at the end of the day. Quickly on the performance here, overall the top number to see is that the overall portfolio increased in value by $1.2 billion. A strong result with the portfolio of about $18 billion. So in 6 months, that's had a strong performance there. And then looking at the 1, 3, 5, 10-year performance compared to about 6 months ago, it hasn't changed very much, just continued strong performance there. Noting that we had talked a little bit about the custom private equity index based on the State Street peer index is one that's been adopted. The performance of the program compared to that index has been close to that index. We'll go through that in a couple of pages, but a little bit below the public equity related benchmark. I think there's been the difference in how the performance has been based upon the strength of the public equity markets over the last several years. But we do note that the program has generated strong returns compared to a public market equivalent. In terms of activity, the program, and we'll have a chart in a couple of pages that'll show more of this on a year-by-year basis, but the program continues to receive more capital back, although in the last couple of months that has changed, but has historically received a lot more capital back than has been called by the underlying managers over time. While that sounds very good, and it is a good thing to get liquidity back, it makes it challenging to achieve the target 13% allocation when your managers are actually giving you more money back than they're calling from you. So that is beginning to change as additional commitments are being made over the last couple of years, and those are being drawn. And just as a mention on that, for the first half of 2018, the staff made $3 billion of commitments. Just updating that today, that's about $5 billion through today.
taking a look at the whole private equity program for the end of the first quarter, what you'll see here is it's broken out by strategy according to the current policy. And the total value, as Steve had mentioned, has increased since Q3 of 17 to 18.7 billion. And 45% of the total exposure is currently unfunded. The top three strategies there, buyout, venture capital, and debt related, do account for about 90% of the total exposure. I will highlight these three strategies here. If you recall, the PE policy review this morning broken out into the two categories, traditional, non-traditional. These top three strategies do fall within that traditional category. Looking at the next page, as illustrated on the previous slide, the private equity program was within the diversification outlines according to the current policy as of the end of the first quarter. The program was allocated 8.4% as of the end of the quarter, which is an increase from Q3, which was at 7.7%. The current target is 8%. And if you'll recall the CIO report this morning, as of August 31st, private equity stood at 8.1%. So it's down slightly from the first quarter. The investments are primarily denominated in the US dollars, and also the geographic exposure is predominantly to US companies, followed by the euro, as well as European on a geographical exposure basis. On the next page, looking at the annual cash flows for the total program, we've highlighted this trend in the past. If you'll see those blue bars there represent the contributions or outflows from the program, and the purple bars represent the inflows or distributions to the program. And from about 2011 forward, you've had very strong positive net distributions into the program. And to put a dollar figure on that, is about 19.4 billion since 2011 through Q1. This is largely due to a strong exit environment and also managers' efforts to sell the assets from the 2005 to 2008 vintage years. I will note that for the first quarter, though, the distributions did fall short of the contributions, and so there was a negative net cash flow for Q1.
But just negative in the sense that there is more money being drawn by the underlying managers that had been distributed. And that is a result of the trend of increased commitment pace that the PE staff has been undertaking over the last couple of years. On the next page, talking about the performance here, what we see is continued strong performance in the private equity program. The 1, 3, 5-year numbers look very strong. The 10-year number includes the 2008-2009 time period. So we expect that is going to also, as discussed in the real estate program and the public equity program, should roll off in the next couple of reporting cycles. Maybe not the next one, but the ones after that, as we go through and see those vintages start to roll off, those time periods roll off. Noting again on the second line there, the custom State Street Index, that's the peer index using the State Street data to compare how the program has performed compared to the remaining private equity market. And that is customized to try to account for the vintage year allocations and the sector allocations that are existing in the CalSTRS program. The next line is the custom benchmark, which is one that is used really more over a longer time period, and that is based upon a Russell 3000 index plus a 300 basis point margin since 2008. So that's a public equity-based benchmark. You can see there that on the excess against the custom State Street Index, the program has been close to, in some cases, outperforming that index, but otherwise pretty close to that. Against the custom benchmark, it has been below. But we do note, if you look at the PE program against just the Russell 3000 or just against the ACWI, which is a global index, that the private equity program would outperform virtually all time periods if it was just done on a straight basis. So showing that the private equity program in aggregate has outperformed the public equity indexes. And that was the comments that I had for the prior page. So happy to take any questions, comments.
Paul?
Thank you. I think going back to, I think it was the first page that you covered, Hannah, where the discussion was that 45% of the commitments are unfunded. So what do we make of that number? Is that a high number? Is that a low number? Does that show that we've made a lot of investments and now we're just waiting for the managers to draw that money down? Or does that suggest that there's a whole lot of money sitting out there and we're just sort of at the mercy of the managers to find a place to put it and we can't really do anything? Since we're trying to increase the pacing, I'm looking for some insight into what that number tells us.
Well, the unfunded commitments, it's we'd have to go back in time to see whether that's quote unquote a high or a low number. We could go and do some statistics. The staff has been increasing the pace at which they've been making commitments. So prior year was a little over around $6 billion, maybe a little bit more. This year is looking to be about 6.5. That compares to prior years in the $3 billion range. So certainly their commitment pace into new funds has been higher, and as we know, it takes some time for the managers to end up call that capital in virtually all the strategies. So seeing that the unfunded commitment amount is increasing is what we would expect to see in this program, given what's happening with the shape of how the commitments are being made. The other comments I would make is that the industry overall, the private equity industry overall, has been having, in general, more distributions than capital calls over the last several years. So the page we had with the little bars, a lot of your peers have the same set of statistics where there's been a lot more capital being returned to limited partners than has been drawn. Would also comment in the industry that the pace of fundraising we do have in our regular report has been quite strong over the last several years, and noting that in addition that that is reported fundraising and doesn't include what we call sort of some shadow capital, whether that's co-investment capital raised or other institutions that have their in-house capital programs. So I would say that the staff is looking into trying to find ways to deploy capital more quickly by undertaking a more robust co-investment program that allows for capital to be deployed almost immediately once the commitment is made. In some cases, some is left behind, but for further on investments. But it allows for capital to be drawn more quickly, looking at opportunities potentially for some interesting secondary investments where more capital can be deployed more quickly. So it's recognized as an issue, but given that the vast majority of the capital that's being deployed by staff is through fund commitments, there are some issues with regards to how quickly that's ultimately generated into underlying assets.
Chris, you wanted to add to the...
Yeah, just to give a historical perspective, if it's a mature private equity program, it is not uncommon to see it about 50-50 of what's invested. So state of Washington in the 90s, when I managed that portfolio, it was about 50-50. CalSTRS, it has ranged because when you look back in the early 00s, we only had about 1 or 2% in private equity, and the board was raising the objective very quickly. So we at one time were almost, I think, 3-to-1 commitments to the actual portfolio just because it was so young and growing. We've stayed roughly, I would say, in this 1/3 to 60% range of the total portfolio, and especially as it has to do, as Steve said, with the pacing of how much we're putting to work. We are, Paul, unfortunately, at the mercy of our partners. given that the EBITDA multiples are so high, it's a time where we're actually asking them to be patient and not buy into these prices. But they do have investment periods of 4 years. Some have already come back to extend their investment period because they don't want to chase these high prices, which is a good thing. But they do want to invest the money at some point.
Thank you.
Frank?
International private equity returns have far outpaced domestic returns for the last 1 and 3 year period. Is that a trend that you see continuing, and are there any plans to take advantage of that premium going forward?
There's going to be a currency effect that's going to impact some of that. What we do observe now as we look at market statistics on, so a good portion of that, substantial portion of the international private equity is in Europe compared to other places. And looking at statistics for where transactions are being priced in the relatively recent past and just recently, that the valuation metrics, EBITDA is a multiple of enterprise value, between Europe and U.S. are very similar. And given relatively similar, maybe the U.S. growing a little more quickly than Europe, I would expect that the performance between U.S. and Europe to be relatively similar at the end, just on a market basis. So I think that most of that effect can be attributed to some maybe some particular underlying managers that have had some strong results, as well as some currency effects.
Okay, thank you so much.
Sure.
Anyone else is in the queue? Hannah, thank you. Steve, thank you.
Thank you.
Item 11 is the continuation of the CalSTRS collaborative model, real estate. Scott Chen, our new deputy CIO. Mike DeRay, come on up. This is, again, information and on INV 429 and 430, it just talks about what the next steps are. So, Mike?
Yes, I'm also joined by Mitch Place, who is
And
assisting
Mitch.
me in writing this item.
Great, so I'll kick this off. And again, my name is Scott Chan. I'm the new deputy CIO. And I just want to say thank you for welcoming me. It's not often you get to walk in a room where people are clapping for you. I'll have to tell my kids that tonight. I'm also just want to say that I'm thrilled to be here working with Chris and a fantastic investment team. So maybe to frame this up, I'll give you the perspective that we're developing an investment vision statement. And we haven't arrived at a statement, so I don't have something to deliver to you today, but there are elements of it. So, number one, honoring our teachers. Number two, developing or building a world-class investment organization. And to do that in a differentiated way. We're trusted stewards. We're not Wall Street. We're not going to be a Blackstone. So it's very unique from that perspective. I believe the CalSTRS collaborative model really fits squarely in that as a long-term strategy that's going to help us achieve that vision. So as Paul Shantik was saying before, what is the CalSTRS collaborative model? It's broadly defined as leveraging social capital. This could mean doing joint ventures with our peers, but I think what it's mainly going to mean is primarily day-to-day leveraging our partners in this implementation decision from investing with external managers to investing directly. And there's a spectrum of doing that, from the co-investing that Margot's doing in private equity, to the joint ventures and management co's that Mike DeRay's doing in real estate, to the fixed income direct investing where we basically own our own money management firm in Glenn's unit, Glenn Osakawa, so in fixed income. So in any event, as Sharon was alluding to, the benefits are very, very significant, right? I think one of the most important benefits is that it allows us to invest alongside our investment beliefs. So I'll call out a few of them. Investment belief number 3, managing investment costs. This going more direct is going to allow us to disintermediate, and we're going to be able to more of that cost for our benefit. Belief number 8, alignment of interest, as Paul was saying. We're going to own the equity, we're going to share in the economics. The split is going to be much more aligned in terms of who makes what in terms of the profit split. And finally, belief number 4, internal management. I think this just directly talks to the control, and it's a risk management feature, because we want to be very disciplined, like the consultants were saying, not buying everything in real estate now. So we want to have control over that function. And I think all this sounds great, right? But can we execute? That's the question. And before I get into can we execute, I just want to say that direct investing is not a panacea, right? It's a very complex judgment. It involves analysis of the returns, the cost benefit analysis, and the risk of execution. Can we mitigate that risk? And so not every decision is going to be apt to have a direct investing decision. We could make better returns perhaps in external management still. So we're going to have to make those kinds of judgments. But can we execute it? I think absolutely yes. The reason is we're currently doing that across our asset classes. And Harry's point, I think part of this is we're going to bring an analysis of the costs that it's going to take to bear down more resources to potentially do more versus the benefits. And we have return analysis already in terms of what we've already done. I think is going to be very interesting. And if you think about the 3 legs of the stool, could we generate as much return or more by extracting also the cost of that out of the system? So, I think in terms of the execution risk, I do want to make the point that this we view as more of an evolution. It's not a revolution. So what we're considering and asking and thinking about doing is potentially more of the same, more of what Mike is doing in terms of real estate, and more maybe going an incremental step a little bit further down the road. So we think that we can mitigate the risks and execute this, but there's a lot involved in that execution. And part of it is thinking carefully about the resources we need, which Mike is going to get into. But right before that, I also want to talk that I want to mention that it's not only the resources, but it's a whole business strategy that surrounds this. And I think there's some challenges and constraints that we have that are worth considering. One of the things that parallels my past position in coming here is the interest in REITs, real estate investment trusts, which are a public version of investing in core and core plus type of real estate. Those values are discounted in comparison to private real estate values. In my former post, we hired a manager, as an example, over a time period of 3 weeks. So I was surprised to come here and learn that through an RFP process, it would take roughly 18 months. And so
We'll beat that number.
12 months.
Okay.
12 months. But I think it just speaks to some of the constraints. And if we aspire to be a world-class investment organization trapped within a state agency, a lot of the state agency processes and rules may not be compatible with an investment process where we need to be a little bit more nimble, act quickly, and so forth. So maybe I'll hand it off to Mike.
Yeah, well, thank you. And I would say this being the last step of what real estate is going to present to the board and talking about the resource needs over the next 5 years, I will tell you one thing, these numbers will likely be wrong because it's a projection for what we would need over 5 years, and we can't predict what the best opportunities will be in real estate over the next 5 years. But we think it's a good, based on our experience of doing this model and growing this model for the last 18 years that I've been here, we think it's a fairly accurate reflection of the needs we would have depending on how much money is invested in real estate and the opportunity sets that are there. Scott coming in was actually timely for us because it allowed us to, Mitch and I, and actually more of the team, Mike Thompson was involved as well, to bounce things off of him the way we're looking at resource needs and how we would look at it going forward, and his experience looking at from how it was being done at UC Davis and other places where he has been. So that has been beneficial, and this was our first shot at it. I will say that in taking a deeper dive into this and looking at how we do things, it really opened our eyes as to some of the unique features that real estate has had that isn't the same in the marketplace for other folks, and that was we have been very fortunate to have a continuity of people in place. I myself have been here for 18 years, and my senior team, the portfolio managers, have really made the investments and made the returns in large part for the system here, have an average tenure of 15 years with the system just prior to Greg Nyland retiring in July of this year. And the loss of Greg Nyland opened our eyes to another thing of, wow, that type of tenure is hard to replace. And we are going to be in the process of replacing that tenure and training people and getting people up to speed for what he was doing prior to his departure, for a year or two to get ready for that. And so the succession planning aspect of this was really an eye-opening exercise for us, and one that is going to be repeated obviously throughout the investment office. As unfortunately, if all the real estate people, the portfolio manager and I stood up, you would say, man, that's a risk. Because we'd slowly stand up, and we're all getting kind of old. So there is a real risk there that we have to address. Okay, so getting into the program, we're going to do a kind of quick review of what we're trying to do here, and then just give you an overview of how we're doing this analysis. And this analysis will be redone again before there's actually a resource request coming to the board. But this is pretty much how we're doing the analysis and how the other portfolios will be doing analysis as well. Paul and Margot to follow, and other groups to follow them. And I'll turn it over to Mitch.
So what I'm going to do is a very brief overview of the collaborative model. You saw this at the last meeting, but I think it's important to just revisit parts of this and highlight that, because I think it just will tie back in and set the stage for the implementation discussion. We really like this chart because what it does is it highlights both the benefits of the collaborative model as well as the challenge of the collaborative model. And particularly for the real estate portfolio, when you look at us moving assets from the open and closed-end funds or increasing our allocation more into the collaborative model, and we talked about this, and Harry mentioned this earlier, we see a better alignment and stronger control with our investments. We also see as a benefit these lower fees. And in the last segment, last month, we showed that and kind of walked through that. But I think the challenge, which I want to make sure we highlight, is that moving in the collaborative model requires more staff time. It requires staff expertise, more staff time, and I think that's the reality. And this is why we like this, is it just shows that if we move and capture the benefits of this collaborative model, it's going to require higher staff time. You've seen this several times, I think, in the last board meeting. But what it shows, and I think why we wanted to present this, is it shows the complexity that the staff will be involved in and the expertise as we make decisions. And you can see in the separate account and real estate operating side of the business, it just requires more time, portfolio, property, and company level decisions, and more expertise. One of the things that Taylor mentioned in his report was just the slow move since 2008 in trying to gain more control. And the separate account joint ventures and the real estate operating companies is where we have that control. But as you can see, that's 65% of the portfolio. We believe that there's actually more room to grow and move the collaborative model further in those two areas. So I can turn that over to you.
So what we try to do in the item is try to show what positions we would need just to keep the same level of the style of investing we're doing now. And then if we're going to expand the program, And so what I show here is just the bodies we have in place. We have very detailed spreadsheets that have this, but this is more simple. And I just want to cut the bodies we have in place. That total is 20 people that we have on staff here. Just to give you an idea, 5 years ago, we probably had 13 people on staff. So over 5 years, although we're saying we may need up to 20 people plus additional 4 in operations, our natural growth has been about not really thinking about the need of additional bodies in the collaborative model, because we're thinking of it that way. We're just thinking this is the normal way for us to do business, that there would be a natural growth over time. And I think that the number of doubling the amount of people in real estate might seem shocking, but as we do the math and think about the issue of succession planning, then the need becomes clear. And I'm going to skip one of these to Scott's point about when we look at specific strategies like a REIT strategy or debt strategies, both of things that we're looking into. We're doing some debt investing. We're not doing REIT investing yet. We also looked at how many people were needed at each level, portfolio manager, associate portfolio manager. And what we found when we go through this, and Paul and Margot and everyone's going to go through similar exercises, as you go to the collaborative model and make these higher level decisions, you have a higher level weighting of the portfolio manager and the associate portfolio manager positions. But you also need that support of investment officers. And by the way, those are the people who are succeeding into those positions. So we need growth at all levels there. Where we end up is if we look at 2023, this is the numbers that we would say generally would need 5 years out if we both plan for succession strategy, appropriately manage the portfolio for the current needs, and assuming we grow the collaborative model over time with new strategies as well. Without getting the detail of this, you can just kind of see what happens here at the PM and APM level is roughly weighted equal with the IOs level. So you don't have a pyramid structure with the collaborative model when you work for a pension fund. And it makes sense if you think about it, because all the higher level decisions are being pressed for the people at CalSTRS to make those decisions. And the operating of the assets is being done by your partners. And so those other decisions and the evaluations are being done by your partners, and we can also utilize independent fiduciaries and whatnot. I want to point out something else. Look at all the people in operations versus what we have here. One other thing that we found over time, it's been historically, real estate teams and pension funds have done their own operations. And that really hasn't been tested so much. And what we found out is, frankly, we think our operations team can do a better job with that. So one of the ways that we think, well, collaborating with the operations team actually to have their specialization help us be more efficient in the way that we do operations. If we just keep it this way, we would have a lot more operations people in real estate, but we actually think there would be savings to the system, better efficiencies, and probably better accuracy to run a lot of the operations through the operations unit. And that's what I was kind of trying to talk about in the item is that type of specialization we think we could be served well by. We already have someone in operations sitting in real estate right now to kind of see how we're doing things, work with the private asset classes, and try to gain knowledge at some point if we were to go forward and say, let's go forward with these ideas. So although we're not implementing anything yet, we're starting to socialize the way we do things and trying to get some help from our operations team, which obviously has deeper expertise in operations than the real estate team has. So with that, I will just say, we just generally made a summary that if over 5 years, and by the way, that does not mean immediately, over 5 years, we think that if we have roughly 20 people added, depending on need, new strategies, allocation to real estate, plus some people in operations to help us with efficiencies, that we would be well set to run this model going forward. We will continue to do work on this. This is only an information item, and certainly we can work with RCLCO, which could help us as they will see these models in the private sector and what they're doing in Arizona as well to help us refine this going forward. With that, I'll open it up to questions.
Yep. Lynn?
Oh, thank you. Thank you for the presentation. I was curious, of these new positions that you have identified, will part of them be coming out of the BCP that the investment office got a few years ago to increase the staff by 50?
I will pass on that question. Chris?
5-year pay.
The answer is yes. So for the board's sake, you don't have authority over these. We have to request them through the legislative process. Department of Finance was nice enough and say come in with a multi-year BCP So we didn't anticipate fully the collaborative model, so we had an initial request, but they left the door open to say, as we work through this, if we need to come back and modify that multi-year BCP, we could do so. So what we thought, those positions, now that they've allocated them, they're really up to you to divvy them out as we do. And so we'll come to you with formal action items of, okay, we want to contribute so many more of those. And what this means at this rate, and what I'm kind of hearing from infrastructure or inflation sensitive and private equity, we would move through those positions faster than the 5-year period. We'd have to come back probably halfway through and say, okay, we got to increase that 5-year plan.
Okay, thank you. And one more question, if I may, and I think this goes back to Harry's point that he made earlier this morning when we were talking about the inflation-sensitive collaborative model. But when you bring the next iteration of this plan back, would you be able to show us some estimates of what the additional cost would be versus what you expect would be the additional returns for this model?
Absolutely. We had some historical references in previous items, but we can update those every time we come forward or when we make the initial request. The savings to date has been, depending on which model we use, been roughly a 5-to-1, even up to a 10-to-1 ratio in fee savings.
Okay, great. Thank you.
Mike, I think it would be, I think you said it, but make note of it. I think anytime, as this goes forward, the cost versus what anticipated the trade-off would be. I think
Yes.
any time we can have that in front of us, it would only be helpful for us. Okay. Paul?
Thank you. Mike, I'm asking, looking at INV 428, which in the materials is expansion of real estate program, and it mentions 3 things. And what I'm trying to understand is, are what we're talking about here changing the model of how we do carry out our strategy, or are we actually changing our strategy? Because points 2 and 3 seem to actually not be talking about sort of the collaborative model. They are saying expand into higher risk categories, expand into new emerging strategies. So I'm trying to separate out the two, and whether what we're really being presented with here is a new strategy for real estate as opposed to a new method by which to implement our existing strategy.
Sure. And I apologize, this can be confusing, and because it's an open session item, I was avoiding any type of strategic conversation, but I can answer the question. No, I can answer the question, actually. I just didn't put the detail in the document. To date, what we've done in the collaborative model is worked on what we used to call the 4 major food groups: apartments, office, industrial, and retail. And for the amount of time I've been here, for 18 years, we had portfolio managers in charge of each one of those asset classes. And the way that we've formed these joint ventures and focused what we would call direct investing, but we can call it collaborative investing, what we called then direct investing, was to form relationships with experts in these product types, that those portfolio managers would be the in-house expert to go out and find those partners. And those were more core-like strategies. So either it was managing core assets or creating core assets. And if we're to go back and look at the materials we've provided, it was centered around core investing, because that's where the bulk of the collaborative investing or direct investing for real estate has been. And it makes sense because it's lower risk investing. It's the timeframes for decision making are longer, and we could move into that space and easier, if you will, over that time period. And we found we were successful, then we would just add on. So what I was trying to show here is that we don't do a lot of that in higher risk categories, opportunistic investing. And to something that Scott spoke to is, we don't think we can replace a Blackstone or a Lone Star, who are 2 very active, higher risk, opportunistic fund managers that we work with and have been successful. We don't think that CalSTRS can recreate that. So we would still go outside to do those things. But there's some aspects of higher risk investing, such as development, that we know we can do. So we'd expand maybe a little bit more into those opportunistic categories and certainly into the value add category. Because keep in mind, most of the model is in core investing in the 4 major food groups. The other one would be, what if we wanted to go into senior housing? We would need an in-house expertise to do that senior housing. If we go into REITs, we don't have a REIT expert on the team now. We're actually borrowing someone. We brought somebody in from Equities to help us with that. We'd have to expand the team we have to have that expertise. The whole key is to have a staff member, multiple staff members have expertise in these areas to expand. So higher risk categories and new and emerging strategies would be things outside what we would call the 4 major food groups of the basics of real estate, those four major food groups. And with respect to expanding into niche strategies, number one, that is just, should we have more operating companies? Right now, we're pretty much at capacity with respect to how much time we have. And we've never really sought out a lot more operating companies. But if the opportunity, presents itself, then we're staffed and ready to go within where the portfolio managers have experience, but we're not ready to go outside of that, such as REITs, such as specialty categories.
Okay, thank you.
Okay.
You want to add something, Chris?
I just wanted to answer Paul's question. Even though Mike's describing expanding, it is not changes in the risk profile. We'll still have the same risk level in
I got that
opportunistic
sense.
value add. We're just changing how we're doing those and how they're broken up.
So
Yes.
So that the collaborative model is going to be an expansion into these areas other than the 4 major food groups where we're already doing that.
Right, but the percentages that we invest in higher risk strategies will change only if we come forward to the board and ask them.
Got it, okay. And thank you, Chris, for helping to clarify that.
Anything else? Thank you for the presentation. I like the approach that we're taking with this in terms of incremental approach, and Joy's recommendation half a year ago that we look at each asset class, and we're doing this slowly so that we're really taking it the appropriate, slow, deliberate process before we ultimately make a decision. And I would just add that it's more than just bodies, and I know you know this, but I think it's worth putting it on the record. It's not just about bodies, but it's people that, one, have the skills that we need, and maybe more importantly, have the values of CalSTRS, as Scott was talking about. Really understand what our mission is, so that if we do expand, it's just not the bodies, but it's the bodies with the values and the skills that we need to continue the great work that we're doing. So thank you. Nice presentation. Lamont, information requests, I think we had a few.
Yes, sir. In item number 3, there were 2 requests. One was for that the future benchmarks not be on the consent agenda, that they be a separate action items.
Yep.
And then the second one in that item number 3 was request for an education item at a future meeting regarding benchmarks, kind of more generally.
Yeah, and I know that there was quite a bit of, a few people mentioned that they support that. I do as well. I think it's, I'd maybe like to talk with, get some feedback as to where that would, the most appropriate place for that education to take place. If it's going to be pretty detailed, this might not be the best forum in this room. It might be in a different setting. But I think it would be a good education forum for all of us. Just have to figure out where and in what setting to do it.
Okay, and you also had one additional one in item 10A. There was a request that, for an analysis of the ratio to public versus private companies, kind of how to think about the fact that there seem to be a diminishing number of public companies and increasing amount of private companies.
Yep, and that was from our consultants as leading up to the asset allocation discussion. That would be helpful for us to have. I don't think Lamont missed anything. That hasn't in the time that I've known him, so I don't think so. Nothing else? All right, thank you, Lamont. Draft agenda, it's, Chris, anything you want to highlight?
Yes, I would, Harry. Cross off number 3, you approved that today. But we're going to add 3, but not a consent item. We'll make it an action item, which is the private equity investment policy. Needs to come back to you. I would highlight number 7. I'm going to ask, that investment insight panel is going to be a group of diversity managers that we have. If we could actually make that time certain at the very end of the day. I know that kind of throws off your schedule, but they'll be here for the reception that evening. And just a plea, if you can block off your calendars for that evening, I know you normally have dinner here anyway, but we will have the reception with all the emerging managers in our cafe that night. It'd be great to have a few of you at least mingle and introduce people. Thank you.
Thanks, Chris.
That's all I had.
Okay. Thank you. Item 14 is opportunities for statements from members of the public. Just want to reiterate, we said at our last meeting in, I think it was July, items which are not on the agenda, we welcome your comments. We look forward to hearing from you. If there are issues that we need our staff to follow up with you on, please be sure you speak with one of our staff members that are here. Geraldine is here. I think Grant Boykin is around somewhere. Who else is here? Diane is here as well. So they will follow up with you. Please do not take our lack of questions or dialogue with you on items that are not on our agenda as us not caring about the issues that you're bringing forth. We're trying to run a meeting and do it through an appropriate process. So let's see. Jane Vosburgh, Bill Vosburgh, and Karen Guma are here to speak to us on fossil-free California. Welcome, Jane. You're welcome.
I made my first public comment here on behalf of Fossil Free California 5 years ago. And today, we at Fossil Free California feel more hopeful than ever that you, the investment committee members, will invoke your divestment policy this year and direct CalSTR's staff to rid the fund of its fossil fuel assets. How can it be otherwise when for at least the last 10 years, fossil fuel stocks have been a drag on the S&P 500, and for the last 6 years, fossil-free portfolios have outperformed their counterparts, with the gap widening in favor of fossil-free funds. And the long-term prospects for the industry look very bleak. You and staff continuously expressed your belief that divesting from fossil fuels would harm the pension fund. And regrettably, CTA also embraced this belief. At last week's Divest Invest Network's press conference in San Francisco, esteemed Jeremy Grantham, co-founder and chief investment strategist at Grantham, Mayo, and Van Otterloo, GMO, presented research on how excluding the energy sector, or any investment sector for that matter, would not reduce returns overall. And you have the slides there, page 3 and 4. You can divest from oil or anything else without consequence. His data goes back to 1925. Bottom line, the fund would not lose money if it divested from the energy sector. In fact, to the contrary, holding on to fossil fuel assets has actually been detrimental to the fund. A recent report by As You Sow cited a Corporate Knights 10-year back-testing analysis of New York State Common Retirement Fund that showed underperformance of $15.6 billion or over 14,000 per beneficiary due to their fossil fuel investments. Because pension funds are so important, such influential investment leaders, several groups are now conducting similar analyses on every major pension fund, and the analysis for CalSTRS will be made available for beneficiaries and the public in the coming months. These studies will show that over the last decade, continued investments in fossil fuels have caused substantial and material underperformance to both CalPERS and CalSTRS portfolios, directly impacting financial returns. It clearly would be prudent to begin the divestment process of this underperforming sector before this analysis is made public and beneficiaries question the fiduciary responsibility of CalSTR's investment committee and trustees. Thank you. I'll let Bill finish the comment.
Thank you. I'm Bill Vosburgh. Another change in the last 5 years that makes divestment judicious is that climate reality has finally hit home. With relentless extreme weather events and raging firestorms punishing communities across the globe, and adding additional cost to our state, we see that climate change, which was a taboo a concept or word just 5 years ago, now dominates the headlines and has become part of common parlance. People are beginning to understand the seriousness of the situation, the existential threat that climate change presents. People are also understanding that just as burning carbon threatens the climate, owning carbon stocks threatens their pension funds. But regardless of whether or when people take note or not, the physics remain constant. To have any chance of adhering to the Paris Agreement, which is still not enough to keep us below the ominous 2 degrees Celsius mark, the scientific community agrees that CO2 emissions will have to begin their decline by 2020, 2 years or less than 2 years away. Currently, emissions are still on the increase globally. We are just about out of time. Out of time for more aggressive shareholder engagement, which Mr. Unterman requested last spring. We're out of time for the Climate Action 100's plus 5-year plan. The time to move is now. Surely you all desire a climate that will support life as we know it on this planet. In order to do this, the world must transition urgently to a low-carbon economy. Persistent investing in fossil fuel companies will allow them to continue business as usual, which has catastrophic consequences for our children and grandchildren. You have the power to effect this necessary transition to a healthier, low-carbon economy. Please delay no longer. Follow New York City's lead and publicly declare your intent to divest CalSTRS from fossil fuel. Your funds, your constituents, and your families need you to take immediate yet prudent action. Thank you very much.
Thank you, Mr. Vosburgh. Karen Guma.
It's me. 160 climate change shareholder resolutions were filed at 24 U.S. oil and gas companies between 2012 and 2018. For 7 years, shareholder advocates have focused on the financial risk of climate change with the oil and gas industry, and yet there has been little to no improvement in emissions reductions of their main product, oil and gas. Oil and gas companies have consistently failed to come up with business plans that are in accordance with the Paris Climate Accords. Oil and gas companies have received more engagement and resolution filings than any other sector, but they have been the least responsive on the key issue of reducing the greenhouse gas emissions from the production and use of their products. The majority of emissions are in the end use of their products, so in order to follow climate goals, either the product or the business model must change. In other words, companies must either invest in lower carbon energy sources or curb new investments in fossil fuel production. Of the companies that have faced shareholder climate-related challenges, 100% acknowledge that climate change is a significant issue for their business, and 95% have a commitment to action on climate change. But that's the easy part. Only 22% have undertaken climate scenario planning, and only 30% incorporate the risks involved into their business strategy. The vast majority do not even report on all of their greenhouse gas emissions, much less have any plans to significantly curb them. In fact, they are investing large amounts of capital in developing new sources of oil and gas. The figures here come from the 2020 report issued last week by As You Sow, available online. It is way past time for CalSTRS to drop the pretense that their involvement in Climate Action 100+ is a sufficient response to climate change risk management. CalSTRS has given up a lot in terms of performance by sticking with fossil fuels and achieved no effect on climate change. It is time to divest.
Our next speakers, pardon if I mispronounce your name, don't hold it against me. Tho Dao, is it Tho Dao? And then Samir Santi from Unite Here.
Yes, thank you, good
How'd I do with the name?
Yes, my name is Todo, and that's
Todo.
spelled Thodo.
Welcome.
Yes, I'm organizing director with Unite here. I'm here to give you some update with about the situation with the Pullman Hotel, which owned by CBRE, and I know CalSTRS is the largest investor with CBRE. Just to walk you back a little bit, at the last July meeting, our president, Anand Singh, was here to clarify some of the misinformation about as who to blame, why that we don't have a fair process of reaching agreement with CBRE to resolve this labor disputes. And I think he did that. Subsequently, shortly after he appeared here, we received correspondence from CBRE. Along with that correspondence was a public statement as to what both sides would agree to what we would be saying about labor disputes. Within 24 hours, with no correction, no changes, our union sent it back to CBRE. And that has been over 6 weeks, and we have not heard anything from CBRE. So it leaves us nothing but to be able to just interpret that CBRE could not get the operator in this situation, is HEI, to agree, whom they hired to agree to settle this labor disputes. Never, in our union, we never seen this situation before, where the owner cannot get the operator to do what necessary to end this labor disputes. That put the life of the worker at risk, and it put the investment or the teacher pension at risk. This leaves us no choice to take CBRE inability to take control over their operator, which is unprecedented. No one, including myself, been in the union for 30 years, that can remember disputes where operator refuse to resolve a dispute after the owner have decided that it's time to end. It should go without saying that your partner, including CBRE, must contract with operator that will manage your assets in a manner that's consistent with yours and your partner interests. If an operator ignore your and your partner decision, they need to be replaced with an operator that will be willing to carry out on your behalf. We're here to ask you to tell CBRE that they need to terminate the agreement with HEI and bring in an operator that will take into consideration of yours and CBRE direction to end this labor dispute as soon as possible. Thank you.
Samir Santi?
Hi, thanks. Samir Santi with Unite here. I want to start by thanking the board and staff for hearing us yet again, and for all your efforts over the past many months to engage on this subject. I'm actually going to use my time to talk about another issue in the hospitality industry. As some of you may be aware, workers at the Palmer House Hilton Hotel in Chicago have been on strike for almost 2 weeks. The Palmer House is owned by Thor Equities. CalSTRS is an investor with Thor, having committed $100 million to a Thor Urban Operating Fund in 2005. Workers at the Palmer House, which is the second largest hotel in Chicago, yet again, have been on strike for almost 2 weeks, and they're striking for year-round health care, among other options. As some of you may know, Chicago is not the most desirable place to visit in the winter. The hotel industry slows down quite a bit. Workers are often laid off seasonally, and many of them lose health care during this period. This strike has been featured in the Chicago Tribune, among many other national publications. So we ask, given that CalSTRS is an investor with Thor, that the board and staff engage Thor and ask them to bring about a quick resolution to the strike. We hope you will be able to do that, as we think this is in your fiduciary interest, as well as in the interest of the workers who have been taking what is the biggest step in a labor dispute and going on strike. Thanks again for your time, and we're happy to continue a dialogue about this.
All right, thank you for being here. And Samir, I know you know our staff well, so you can communicate with them a little bit more into detail about the issues you brought to our attention just now. Britt Dowdy. Britt, nice to see you.
Hello. So this is the first board meeting I've been able to attend, and so as a CalSTRS member, first off, I want to thank all of you for the hard work and dedication you have. The level of detail that you've done to prepare for these meetings. So my wife and I, who are both members, thank you for your hard work. Largely, I'm here as a representative for the California Federation of Teachers. I serve as a vice president on our executive council and a member of our retirement policy committee. And we want to thank you for paying attention to and taking action on the various environmental, social, and governance issues, especially for the reports that have been given today and being able to integrate those issues throughout many presentations today. Members of CFT continue to be concerned about their money being invested in private prisons and immigration detention centers. And our executive council recently passed a resolution seeking multiple methods to address those concerns. And we're seeking changes in corporate behavior or a change in our investments to match the collective ESG policies of our members and those of CalSTRS. These detention facilities negatively impact our students by separating families or causing relocations during a school year. And as educators, we all know that according to Maslow's hierarchy, that a student is most concerned about their basic needs and family structures over the academic success in the classroom. When our students face stress of family separation, they're less likely to learn, and they may suffer deep levels of stress and anxiety, which affects their mental health. As a diverse group of educators, we're deeply concerned about mental health and family stability of our students. We look forward to a day when our pension investments are not at cross purposes to these ideals. So we thank you for scheduling a conversation regarding private prisons in the near future on a future board meeting. We acknowledge that CalSTRS is taking action to change corporate behavior, and we acknowledge that this takes time, and there's broad issues at play regarding any pension fund investments. I think that all of us, including the board, wishes that corporations would change their behaviors to be consistent with the environmental, social, and governance policies of CalSTRS. And in CFT, we want to work with you, the CalSTRS board and staff, on a state level, and with the AFL-CIO on a national level to help influence positive corporate behavior as quickly as possible. Thank you.
Thank you. I'm going to ask the staff to update the committee as appropriate on some of the issues that have been ongoing without having a discussion here in open session, and to the extent that it's appropriate to brief us in closed session on some of these issues that are about specific investments that I believe could fall under the purview of closed session. So I believe I see Jennifer Baker approaching the mic. Jennifer?
Good afternoon, Jennifer Baker with the California Teachers Association. Appreciate the comments from our sister organization regarding actions of ICE. I did want to say thank you on behalf of CTA for the letter that Grant sent to Eric Hines in regard to the letter that we sent to the board regarding Core Civic NGO Group in July. We do look forward to a thorough response to the specific questions that we've asked in regard to the actions of both these two private prison companies and in specific regard to your investment policies and beliefs that we also included in the letter. And we look forward to getting a response to those questions in concert with the ongoing discussion that you're having internally with staff. We also look forward to the conversation that you're going to have in November. And there are difficult conversations that we need to have, but at the same time, that's how we make the constructive conversations that can hopefully lead us all to a better future. So I did want to say thank you to the hard work that you and your staff are doing, and we're in this in the long haul and look forward to the ongoing discussions. Thank you.
Thank you. Paul, I see you're in the queue. Did you? No? Okay. All right, great. Thank you everyone for thank you again for being here. Good luck with your struggles. Be sure to speak to our staff, and our staff will appropriately update us on the progress that is being made to the extent it's appropriate for the committee to know what's going on. Thank you. With that, we're going to go to closed session in the back, and we're going to have item 21, and then we'll come back for the closed session semi-annuals.
Who do you want?
We'll probably need about 30 minutes, so it's going to be Steve McCourt from Makita, Chris, I think Scott Chen, Deb,